So
Which leads to
what?
segment three.
Segment three, which is we want to talk about something that is a little bit different from the investing side, and it's personal finance. Personal finance, I think of it as like the defense of your money management, the structures of things. And it really starts there because without good personal finance, the investing stuff, as fun as it is to talk about, really doesn't matter. So you need to have your ducks in a row, your expenses in order, know where your money's going, things like that. So Gerry is actually going to, I have a feeling I know what he's going to say, but I don't know for sure.
It's
Gerry
my
wants
favorite savings plan.
favorite savings plan of all time, right?
Gerry's favorite savings plan.
Okay.
And this
So,
ties right into the mutual fund, and particularly for young investors trying to save. And I can't emphasize more. I heard it all over and over again when I was young. Now that I'm old, I'm going to say it like I was old, an old person telling me when I was young. So they talk about saving regularly, dollar cost averaging, which we'll get into in another, what is this segment? But
maybe
what it is essentially averaging in over time into the market. Great way of investing, especially small dollar amounts, periodically, planned periodic investments. That can be every month, every 2 weeks, whatever. Might get a little crazy if it was anything more than every 2 weeks. Every quarter is even fine. But what I really like is a savings plan using invest. So really, it's a savings and investment plan. And what you do, let's say, forget where the market is. It doesn't matter where the market is as far as, is it up, is it down, is it sideways? You make an initial investment into a fund, and then you set up, and maybe that's even only $1,000. And let's say you've determined that, well, I can save $500 a month into, and this is outside of retirement plans, 401ks, those kinds of things. We'll talk about that another time. I'm sure we'll do a what is this on 401k. But most people who are working know what a 401k plan is. This is over and above that. And what you do is you take half of the money that you would normally save or invest, and you put it in that investment. The other half, you put it in a cash type investment, money market fund, if you will. It's readily available, easily accessible. And just continue on that path for, on in, on out, whatever, however long it takes to get what I'll call a reasonable correction in your investment side. And I say that's 15%. If there's a 15% correction, then you take half of the cash that you've raised and you put in half of it. So remember, you've been putting $500 a month away. $250 automatically goes into your investment account. $250 goes into your cash account. You have a 15% drop in the value of your investment. You take half that cash and buy, and then keep on that same path again. There's another break point, if you will, at 20% down from your investment. Take that half of that, what's left, and put it in. Put it in. Okay, and then let it ride. Keep doing the same thing, and little by little, market recovers. It's coming back up. What you're doing when you do something like this is you always have cash available, perhaps for an emergency, but more importantly, available when you have a market correction or a bad market. Now, sometimes you might get to the point where, and I mean, the numbers could get ridiculous where if you keep cutting it in half and cutting it in half and cutting it in half, hopefully the bear market doesn't last that long, or a correction doesn't turn into a long-term bear market. At some point, if you get to 25%, you take the whole thing and you just dump it in there and say, look, this is crazy.
Yep.
And I think that that's a way to keep yourself from, if it's the top of the market, you didn't buy everything at the top. I mean, if it's the bottom of the market, that's going to work against you. But at some point, you'll get a correction and you'll be able to buy. And if nothing else, and we've actually done some statistics on this, and it didn't really surprise me that it didn't necessarily make a huge difference in returns. But more than anything, psychologically, I think it's helpful. There was a little bit better return, but there's so many things that can come into play. And the reality is you're probably, from a performance standpoint, you probably are better off dumping it all in and just leaving it alone, regardless of where the market is, and just keep adding to it. But this is a way that gives people some level of peace of mind, so that they are truly saving in cash, and they are truly investing with with half of the money, and it gives you a natural value type of approach to your savings and investment plan. By when there's a drop, you buy more.
And I should say,
I'm not going to say that it couldn't work very much in your favor and better than if you had just dumped it all in at once. It could very well do that. It's more, I think it's better from a psychological standpoint, because so much of investing is psychological to the extent of, and I'll use a Warren Buffett statement, investing is more about your stomach than your head. And when I say psychological, you think head, but what it really is your gut. Oh, can I handle this? Do I have the stomach for the volatility of the market, especially today? It's just gotten so darn volatile. So I think and that psyche is super important, because what tends to happen with the average investor when there's a difficult market, what do? They panic and sell, which is like the worst thing they could possibly do. So this is like training you to do the opposite, and keeps you liquid enough that if you should need funds for some reason, you got some. That's my favorite savings and investment plan.
To your point, most of the studies indicate that the best time to invest is when you have the cash to invest. So you get a lump sum, put it in the market. But while markets work, humans don't always work. And so
exactly.
It's difficult to do. So if you can do little, for lack of a better term, hacks like this that are going to make it easier for you to stay in bounds, then by all means, do them. Use tricks, acknowledge the fact that you're human. You need psychological tricks. You need to fool yourself and work with humanity. Don't fight against it too much.
Right. And I would say that doing that didn't hurt anybody. The analysis, we did an analysis a few years back, and it was over 20 years. And it didn't hurt anything. It didn't really make that much of a difference. I truly think it's more of a psychological thing. And again, that's not to say that it wouldn't work for you. The tendency might also be there to say, there's a correction in the market, let's just throw the whole thing in. And that might actually be an even better way from an investment standpoint. I'm just trying to say discipline and always leaving yourself with some cash available is not a bad idea.
The one thing you can control is when you're buying after a correction, for a fact you're not buying at an all-time high. You know that.
Yeah.
Doesn't necessarily mean it's not going to go farther down. It just means you're not going to buy at an all-time high.
Yeah. And, they used to say it's not timing the market, it's time in the market. And that is completely true. But it doesn't change that people psychologically make mistakes when they come in at peaks, and no one knows when the peak is. You only know it's a peak after. And, but people that come in at a peak are often ones that, they come in at a peak, a year, 2 years, 3 years later, it hasn't fully recovered yet, and they're selling out at a bottom or whatever. And that really is devastating. So this is a technique or a tool to keep you from making those mistakes.
And something to keep in mind is whenever you make a big change, this happens when people see performance and they go to a new advisor because that advisor's had really great performance, and they have an inflection point there. You need to be ready psychologically for the next big move to be down. Don't just expect, if you jump on the ship of a hot money manager after they've had a good run, if you jump on it, that you're just going to see the run continue. You've got to be prepared for the fact that, hey, the next big move could be a move down. Am I okay with that?
Mm-hmm. Yep.
Don't move unless you are.